To help us do that, I want to welcome in TD Ameritrade Network contributor Jenny Horn. Good morning to you, Jenny. Let's talk some Five Below. So this is, to me, the modern dollar store in the sense that, you know, a dollar just doesn't go quite as far as it used to, but $5 might.
Absolutely. And this on social media is actually sort of like the fancy dollar store is what I gathered this morning. And actually, if you compare it to, say, Dollar General and Dollar Tree, its price activity looks a little bit different this year. So it has shed about 12% month to date, and it is lower today and lower this week. But generally speaking, if you look at a longer term chart in Five Below, it's stuck pretty sideways. So it has seen that degree of selling really just recently. But in a longer term picture, it is still very positive, I believe. I mean, it fell to as low as $47 a share and surged by about 4 times to over $200 a share in March of this year. Now it's about $30 off of its all-time high, but relatively speaking, it has really been on an uptrend since last March. Now, they have first quarter earnings today after market close, and analysts are expecting earnings of 66 cents a share, which would signal 170% year-over-year growth on revenue of almost $557 million, which would signal about 176% year-over-year growth. So these are pretty astronomical numbers. Now, I do think these will be tough comps to deal with going forward because, of course, this is comparing Five Below to the first quarter of last year when so many stores were closed. But I do think that those growth numbers are just significant and show this company's resiliency in a time where it was very difficult to be a retailer. Now, there are so many things going on with Five Below. Their first quarter performance is really likely to be benefited from, you know, so many different things we talk about with retailers. One being this rebound in supply chain. Another being, of course, the stimulus spending. But I think this is really interesting because Five Below sort of operates in a niche market. They sell, you know, games, technology, all of these different sort of trinkets under $5. So their target market is really teens and tweens, which they were calling them. So really, this has a lot to do with the parents, less about these children, because this is a very toy-centric company. And actually, they stand to benefit from so many toy companies that have closed. I mean, Toys R Us filed for bankruptcy back in 2017 and closed about 700 stores in North America. And this might date me a little, but then there was, of course, Zany Brady that once existed. Five Below is sort of one of the last standing, you know, traditional toy stores. And actually, there's sports good, games, toys, and books and arts and crafts, which to me all sort of falls under that toys umbrella, makes up about half of their $2 billion in annual revenue. Then there's t-shirts and beauty products make up about 30%, and their smallest segment is these seasonal products or different party favors, which only makes up about 19%. So they are a bulk toy store. That's just how they operate most of their money. Now, what is interesting is their expanded partnerships over the last few years. They now have a partnership with Instacart to sort of enhance their contactless delivery, which has been very cool. And one of these trends I expect to persist as we head into a more reopened economy. I don't see this Instacart partnership necessarily fading. Another interesting partnership they announced back in 2019 is Nerd Street Gamers to open esports gaming centers. And they've only opened a few thus far. I think the pandemic sort of slowed this. But I think that is an interesting partnership. Esports, as we know, have risen to huge popularity over the last year. And one of the bullish arguments for this company is just the fact that they're able to still reopen stores. They reached 1,000 stores in 2020 despite the pandemic. They have plans to open another 170 to 180 stores in the next year. And I think this is really just fueling positive sentiment, the fact that they're still able to grow in light of the past year. And really, the noise on social media is super positive in this name. I'll be curious what LikeFolio has to say, but this name is beloved. I mean, people just go on and on positively about Five Below, which brings me to our first tweet of the day, which says, bargain stores like Five Below and Dollar Tree are getting all of my money right now. So I saw this tweet 100 times over, people saying they were either A, spending all their stimulus money at Five Below, or B, this is a great place to go when, say, you're economically strapped or you lost your job. It is a more affordable retailer. So for that reason alone, I mean, it benefited sort of from two different ends of the spectrum. But our next tweet sort of focuses on this growth and some of the reopening of stores, like I just mentioned, which says, a tell for good growth stocks is when you suddenly notice the company's locations everywhere. Worked well with Academy Sports and Outdoors, Five Below, and DaVita last year, and with the Joint Corp this year. If you suddenly notice 10 plus new stores, and they're not over levered, it's probably a decent trade. So I thought this was interesting. I mean, they are still a dwarf compared to Dollar Tree, Dollar General, which both boast over 16,000 stores nationwide. Five Below only has about 1,000 stores now. But I think this fact that they're promising to open 170 new stores in the next year is a very good sign, especially because lately I've noticed you walk around cities and it seems like more and more retailers are closing. I mean, the empty storefronts are everywhere. So I think their ability to actually expand is a very good sign for this stock, you know, despite some of the different activity we've seen in other discounters lately, Kevin.
Yeah, Jenny, the question really is, the relationship, it's interesting. The relationship between Five Below and Dollar Tree and Dollar General kind of remind me of the Jimmy Buffett song where he puts a quarter in his penny loafers to fight inflation. So, clearly the price tag of everything you do has gone up. But this store that focuses on teens and preteens, right, is enormously popular, growing, like you said. The question is it like Dollar Tree and Dollar General, or is it different and better than Dollar Tree and Dollar General? And LikeFolio's data will help us with that decision, because Dollar Tree came out with their earnings and sold off hard. So even if they're different, are they good enough to hold on to the price of their stock during this? They've already sold off after Dollar Tree's earnings. So I'm really interested to see LikeFolio's data on this, guys.
I'm with you, Kevin. Let's do just that. Jenny, great setup here for us. I'm excited for this report as well. Jenny Horn, TD Ameritrade Network contributor. Look forward to talking to you again soon. So we say goodbye to Jenny. I want to welcome in the co-founder of LikeFolio.com, Andy Swan. Good morning to you, Andy. Thanks for taking the time and joining us here. Let's talk some Five Below. This has been one from recent conversations that I have a hunch you guys like, but I just want to know how much better do you like it than its peers within this discount retail space?
Yeah, we have liked Five Below for quite a while. I think since it was under $60, LikeFolio's been pretty bullish on the name. One of the reasons is that the company really has a high level of consumer happiness, significantly higher than those two peers. I think we're talking 10 points higher, which is very significant in the retail space. So, consumers love this company. Now, what gets tricky is when we start talking about earnings, because like you guys have previewed so well here, both of those competitors sold off after pretty good reports. Five Below has sold off in conjunction with them. And when we look at LikeFolio purchase intent data, it can actually be a little bit confusing. So this is a number of people talking about going into Five Below stores or purchasing online compared to the competitors. And you can see on a year-over-year basis, the change is the only one positive. It's up 17% year-over-year compared to the other two, which were down significantly. But a lot of that is really just due to the fact that Five Below shut down a lot of its stores last year. So it's comparing to kind of a dormant phase, whereas the other two, especially Dollar General, really benefited from the pandemic as people started to do some of their grocery shopping and some of their essentials like the toilet paper runs were at Dollar General. So this is a very difficult comps report to figure out. We think it's more likely than not that Five Below takes a little bit more of a breather. We don't see this stock screaming to the upside after this report. The numbers we have look pretty good, but the expectations are really high. And so that's always a tough combination. But long-term, LikeFolio likes Five Below quite a bit because of its growth strategy, its ability to make consumers happy, and the fact that it's still considerably smaller than a lot of its rivals.
See, now, Andy, there you go, putting a different lens on the LikeFolio data than is just to the naked eye, right? The Dollar Tree and Dollar General data that is down is not really comparing apples to apples, because Five Below's positive 17% is against closing, right? So the real question though, confirms this or not. Are these companies the same or are they different? Right? And if they're different, and what do I mean by different? Is Five Below eating Dollar Tree and Dollar General's lunch? Or are they the same and they're, in that case, vulnerable to at least, right? We don't necessarily have to know that the stock's going down, but if it's not going up, that's enough of a good answer for us. So we just need to know, are they the same or are they different in a bigger picture sense? Andy?
Yeah, bigger picture, they are different. I think when we look back to,
right.
Purchase intent mentions at LikeFolio over the last 90 days versus 2019. So taking the pandemic completely out of it, Five Below, the only one of the three that shows positive growth. It's the only one above 72, 73% happiness levels when the others are down in the low 60s. It's a better company, it's a better experience for consumers, and consumers are reacting appropriately. And I think they have a pretty good strategy. It's just open more stores. It's pretty simple. These stores are working, open more of them. I think you've got a lot more saturation on the Dollar Tree and Dollar General side, a lot more room for upside for Five Below. But it's just a really wonky earnings report to try to get into and try to predict. So really want to emphasize the long-term nature of our optimism for this company.
Yeah, Andy, if I sum it up, and please correct me if I'm wrong, it sounds like if you were in a position already, it's kind of a hold, don't necessarily dump the shares. But if you're looking to get into a long-term position, you could see a bit of a pullback just because we've seen it across so many different names that there may be a better opportunity to enter that name. And then as far as the short term, it's hard to tell because of what you said with the nuance to the data. Is that kind of sum it up?
Yeah, and just like you said, it's also just a tough market to be incredibly bullish going into earnings. I think it's a sell first type of market, at least so far this earnings season. So that makes it more difficult as well. So yeah, you're right. It's just a difficult trade on earnings, but long term, it looks like a pretty clear opportunity.
And Andy, I want to say thank you as well for really highlighting, I think, one of the most important lessons in the financial markets, probably applicable beyond that as well, which is when you have some information that looks, odd in some cases. If you're comparing these companies and you see one that has really, or two in this case, have really poor numbers, and the others look really good, asking the question why. Trying to figure out why that might be, that could highlight some pretty crucial information. And if you, like Kevin said, if you just looked at this chart and I had no context, that tells me a completely different story than what you told us here on the show. And so that's why we appreciate all you guys do at LikeFolio, but really appreciate kind of even the deep dive within the data and asking that one extra question that can be so crucial.
Yeah, that's what an opportunity to come on Fast Market gives us, and we love to do that for this audience, and the feedback we get is incredible. So I do think that anytime something looks like an easy layup, it's worth digging a little bit deeper because it rarely is.
Couldn't have said it better myself. Andy Swan, the co-founder of LikeFolio.com. Look forward to talking to you again soon. Thanks for joining us as always.